Okay, all right, let's go ahead and get started. Again, my name is Jason Maida, in case you didn't hear my introduction earlier. So it's great to have you this evening for our Los Angeles-based homebuyer workshop. Really excited to bring this content to you. All of the workshops that we teach, generally we'll teach them once a week. And so we teach them kind of regionally throughout the state of California. In case you didn't hear earlier, Ken Fleck's going to be taking some of our questions that we have while we roll through tonight's presentation. We'll bring those questions to the larger audience and kind of answer those on air. We do also have Leanne Walker joining us this evening from CalHFA. She's going to be sharing with you a little bit more about the CalHFA Assistance Program, which will be in the latter part of tonight's discussion. Just a little bit about me. So I'm the manager of American Pacific Mortgage. We're based out of Sacramento, but we service all over the West Coast. Our company services nationwide. And I've been lucky enough to be in the lending industry for the last 20 years, and I specialize in first-time homebuyer programs. So you're going to learn a little tonight about the CalHFA Assistance Program. And like I said, Leanne's going to share some of that information with you later this evening. But you're also going to learn more about some of the other products, as well as conventional loans, FHA loans, VA, USDA loans. And so our goal tonight is to help build kind of a home buying game plan for you. So as you move forward on this journey towards home ownership, you kind of have all the tools and resources that you need. Let's kind of look at tonight's talking points. So we're going to spend some time looking at the housing market and a lot going on there, especially as we're entering the spring buying months. We're going to talk a little bit about interest rates in a bit as well. And then as we kind of launch in tonight's discussion, we're going to look at a quick little buy versus rent calculator to kind of do some budget planning. We'll also look at credit, how to optimize your credit score as you're getting ready to purchase. Take a look at student loans and how they may impact your qualifying. Look at various loan programs, as I mentioned earlier, talk about some of the documentation needed. And then we'll kind of roll into the CalHFA Assistance Program with Leanne later on. And then we'll wrap up tonight's discussion looking at the loan process. We call it our 6 steps of home buying. So we're going to walk you through all those different milestones going from pre-approval all the way to step 6 when you're getting the keys to your house. And then I want to talk to you a little bit about a consultation later on this evening, kind of what that means for you as you're looking at the home buying process. So let's talk a little bit about home buying and why it may or may not make sense for you. Now, purchasing a home is probably going to be one of the largest investments you make in your lifetime. So it's a big deal. And hats off to everyone that's joining tonight's conversation, because obviously you're investing in educating yourself on preparing for this very large purchase. And when you're thinking about buying a home, it's a lot obviously different than buying a car, right? And there's a lot of great benefits that come with owning a home, since it's going to be such a large investment for you. It creates stability in your housing payment, so we don't have to worry about our rents going up, once a year once we renew our lease. This is an asset, so you have the ability to be able to pass along this asset to the heirs of your estate. Growth in equity of your home, so whatever you owe on your balance versus what the market value is, that difference is called home equity. And there still remains some tax benefits with purchasing a home. So even though we had some tax changes in 2018, there's still some fantastic benefits that come along with home buying. So as we're preparing to buy, we want to do some budget analysis. And so we want to kind of take a look at where we're at today from a rental perspective versus what it could look like in a buying scenario. So a great tool that we like to share during our discussions in these homebuyer workshops is the buy versus rent calculator. And it's brought to us by Freddie Mac. And so I'm going to walk us through kind of a side-by-side comparison as we launch into tonight's discussion. By the way, as a side note, all the material that I review with you this evening, we're going to send out to you via email. So you'll have that as a kind of some tools and resources for you on this journey towards homeownership. Before I go on the calculator too, I do want to apologize to all of our audience members. I know we had to move around tonight's discussion, so it was scheduled for Wednesday, but we had an overlap in some of our other classes that we're teaching. So thanks again for kind of adjusting your schedules to be able to join us this evening. I know we had to kind of move that around at the last minute. So, thanks again for joining us. Okay, so let's go in and take a look at this buy versus rent calculator. So we're going to be primarily looking at more of an LA market. So I'm going to adjust some of our rent numbers, and we're going to go ahead and plug in, let's say, a $3,000 rent payment. Now, I know for some of you joining us this evening, that may be higher or lower than what you're used to paying. Monthly renter's insurance, we're going to assume $15 a month for renter's insurance. That could be a little bit more. And we're also going to assume yearly rental increase of, let's say, 3% on an annualized basis. So we'll plug that in. And then let's look at a home purchase. We're going to say for this exercise, we're going to say a $750,000 home purchase. And then The minimum down payment usually at 750 is going to be 5%. I'm going to talk to you a little bit more about what that means here in just a minute. Property taxes on 750,000. Let's do a quick calculation. So let's see. Boom, boom, boom. So we're going to assume about $9,300 a year in property taxes. And then as part of owning a home, we have what we call homeowners insurance. So that's going to cover the actual structure of the property as well as any other perils. You have maintenance schedule on the property. So obviously when we own a house, we're the owners, we're responsible for any type of upkeep that we need to do on the house, but also any kind of annual maintenance that you do. So let's carve out $2,000 at least in our budget. Obviously, if we buy maybe an older home, we might have a larger maintenance budget that we need to settle up for. And then in terms of the loan information, we're going to plug in a 30-year fixed mortgage. Most of our first-time buyers, I would say 99% of our first-time buyers are going to do what we call a 30-year fixed mortgage. That means it's a fixed interest rate for the full 30-year duration of the term of the loan. Interest rates, now average interest rates are started to uptick quite a bit here over the last couple months. I'm going to change this closer to 4.5% because that's the actual average interest rate right now in the marketplace. Now, origination charges, those are what your lender charges will be. We generally would charge a $995 underwriting fee plus a $910 processing fee. For those of you that may have heard about our workshops through some of our partnerships, we actually reduced that processing fee from $910 to $160. So if you're affiliated with one of those partnerships, we'll talk more about that later. That can help reduce your overall costs. And then discount points, those are costs that you can pay to help reduce the cost of your interest rate. Usually when you pay discount points, it's 1% of your loan amount. So let's say I'm financing $600,000, 1% of $600,000 is $6,000. And why we may want to do that, because paying points will help bring down the interest rate of our loan. Usually one discount point can bring our rate down about 1/4%. So like in this scenario, let's say we have a 4.5% rate, we decide to pay one discount point, that could potentially lower the interest rate from 4.5 to 4.25%. And then other settlement charges are going to be like title, escrow fees, transfer taxes. And so these are going to be all part of closing costs. And closing costs can usually be anywhere between 2 to 3% of our overall sales price. Last tab we want to open up on this calculator is the other assumptions, which we're going to assume an appreciation rate of 3%. For some of our buyers that have purchased in the last 2 or 3 years, they've probably seen 10 to 15% appreciation rates. But for this scenario, we want to look more about a conservative approach long-term, and we're going to say 3%. And now expected years in the home, we're going to say 7 years for this conversation. Selling costs of 8. And what that means is that when I sell my home in 7 years from now, because that's the projected scenario we have here, I'm going to pay costs to sell my home, which would include realtor commissions, closing costs. And as a buyer, when you're purchasing a home right now, your buyer's agent that represents you, you're not paying the commissions for that realtor. The seller's actually paying for it. Now, when you turn around and sell a house 7 years from now, then you would be paying those same commissions. But at the onset as a buyer, you would not be paying realtor commissions. And then finally, state and federal taxes, we're going to assume 33.8% and then a savings rate of 1%. So if we were to kind of put side by side these two payments, so we have roughly about a $3,000 a month rent payment. Now our mortgage payment is going to be a lot higher, right? So it's going to be closer to about $5,100 a month, including our principal and interest, taxes, insurance. And so our expenditures are going to go up by over $2,000 a month. Now the opportunity for us when we look at buying versus renting is that over the next 7 years, with my tax deduction, my growth in equity, when I sell my house in 7 years, I potentially have an opportunity of $96,000 in growth opportunity, really. Now, obviously, we're paying more on a monthly basis, so we realize that. But this kind of shows you when you put side by side renting versus buying where really opportunity can lie for you. Now, if you're paying a lot lower rent rate and you're buying a $750,000 house or whatever the number is, obviously those numbers aren't going to be as favorable for you. But certainly with average rents around $3,000, that it would make sense to buy in this scenario. Now, this is assuming a single family residence. If we looked at more of a condo, then you have what we call as homeowners association dues. So that would change the overall monthly budget. And so let's say they're $300 per month in HOA fees, then we would have to factor that into our budget. Okay. So that's our rent versus buying calculator. So let's jump back into our slideshow now. And again, in case you didn't hear it earlier, we're going to send you all this material here tomorrow morning, so you'll have that. All right, let's talk a little bit about the housing market. Lots going on there. We're now entering the spring buying season, and so lots of activity from a buyer's perspective. We're still looking for a lot more inventory to help support our buyers with different choices to make their home purchase. And that's really the challenge we have right now in our market: lack of inventory, high demand. And then, as interest rates are changing, which I'm going to talk about in just a second, a little more urgency from buyers to find a house, and there's just not a lot of choices to choose from. So hopefully sellers are going to start to come to market now with properties. At times, we're seeing what I would call is a little bit of a softening in the market, where not necessarily values that we're appraising when it comes to the lending side of things are matching up with purchase prices. So, we hope that these prices are going to start to maybe stabilize or maybe flatten a little bit. This gray bar here represents the start of the pandemic. And as you can see, this just rapid trajectory of home appreciation from 2020. It's still going today, but we're hoping this kind of is going to crest a bit here, and we can see some flattening. And we're seeing some signs of it in certain parts of the market. If we go further into more of the eastern side of LA County, we're starting to see a little bit of flattening, maybe a little bit in Riverside and San Bernardino. So it just really depends transaction by transaction, but we're hoping that we can get overall more inventory to the market. Now, what's led to this massive appreciation? Well, if we look at the right around probably September of 2020, we saw rates hit their all-time lows of 2.625%. That's fueled a lot of the energy in the buying market. With the start of the pandemic, the work from home has changed quite a bit. So more people are looking at more of a remote employment situation, which has encouraged them to work from home and then, invest more in their home environment. So those kind of are changing the buyer behaviors, and that's what's led to this high demand. Now, with interest rates starting to change a bit, and we're going to kind of talk about that now, there is a recalibration, if you will, for buyers that have been currently pre-approved, especially over the last year. So if I got pre-approved in 2021 and I just couldn't find a property and now I'm still in the market, some of our buyers are having to recalibrate their purchase price or buying power because rates have changed. The average interest rate, I know we have on the slide, is about 4.25, but things are moving so fast in the market. Average interest rate now is ballooned to about 4.5%. If you compare that year over year, we were probably looking at about 3.1% same time last year. So we've seen well over a full 1% increase in interest rates. What's leading to that right now? Just a lot of volatility in the financial markets, huge inflation, and what many of you have probably been seeing is the Federal Reserve is increasing the federal funds rate. We heard a 0.25% increase this month. We have seen some of the Federal Reserve leadership come out and say that they might project another 6 increases in the balance of this year. So a lot of those are leading to kind of early drive ups in interest rates. So that's something we're going to really have to watch as prospective buyers, because as we see interest rates rise, affordability changes, right? So that's something that's going to be really on our radar as we move through this year, because as we consult with clients in designing home buying options, interest rates plays a huge role in what their eligibility looks like. If we were to kind of look at the 30-year fix going back, I want to kind of look at the last 2 years. So right here, I think I mentioned it earlier to you, this is kind of where we saw the bottom of the rates, where we hit about the 2.625, and you can see going into 21. We saw rates kind of move up a little bit into the 3 level. Right around February of last year, we did see interest rates start to move even pretty aggressively towards the 3.5% level. And then they came back down. And then you can see right here is just the really big spike in interest rates, which we've seen interest rates move almost a full 1%, which has definitely changed the landscape of buying for our future home buyers. Now, that being said, it hasn't cooled off the interest of buyers. So there's still a lot of buyers out there. We've just, like I said, we've had to kind of recalibrate a bit affordability. Now, when we think about interest rates, it's not just a one size fits all for interest rates. Interest rates depend on credit eligibility, so what your credit score looks like, the product that you select, how much you're going to finance, how much you decide to put down. And you heard it a little bit earlier, which is the points that you pay for buying for your interest rate. So buying down your interest rate with additional costs. And then finally, the term of your loan. So whether you're doing a 30-year loan, 25-year, 20-year, 15, maybe even a 10-year loan, the lower term you take, generally, the lower interest rate you will be able to achieve. As I mentioned earlier, though, most first-time buyers are going to be utilizing a 30-year fixed mortgage product. So one of the components to achieving a low interest rate is credit. And as we prepare for home buying, we want to make sure our credit's in the best possible position to be able to achieve the best financing package available to us as future home buyers. So one of the things we like to do in the workshop is kind of talk a little bit about credit and give you some tips and resources as you move forward. To the right on this slide is the FICO score kind of calculation to show you the weighting of FICO score. So 15% of the score is based upon how long you've had credit. So the deeper my credit file is, more mature it is, the better my potential credit score could be. 20% is going to be how much new credit I have that's coming online, as well as, and more importantly, how many inquiries that I'm doing. So usually inquiries that we're looking at are what we call hard inquiries. Now, in starting the process with us in doing a consultation, which you're going to learn a little bit more about later on this evening, we start with a soft credit pull, which doesn't impact your credit score. Hard inquiries can impact your credit score. Now, when you apply for a mortgage and a lender does a hard inquiry, you have a 30-day window of time to apply with as many lenders as you want, and it's the equivalent of one credit inquiry hit to your score. Same thing holds true for auto financing. So if you decide to run to the auto mall, which by the way, don't do that if you're going to plan on buying a house here in the next few months. But if you do decide to finance a car, the same clock will start. So day one off your first inquiry, you have a 30-day window of time. 30% is going to be how much you owe. We also call that credit utilization. So which is how much do I have in credit card balances versus what do I have in credit limits? Which is probably the most influential with most of our clients that we consult with. And then the final weighting is 35% for payment history. So basically how well have I paid my bills? Credit ratings usually look at 30-day delinquencies, 60, and then 90 plus delinquencies. Obviously, the more severe your delinquency is, the more impact to your credit score. Now, when we look more specifically at amount owed, or also known as utilization, one of the things that comes up quite a bit in our consultations with clients is, Jason, I had the habit of paying off my credit cards every month, but it looks like when you're looking at my credit report, it still shows a balance. The reason why the credit bureaus have a balance when maybe you're actually paying off your credit cards is because the credit reporting agencies pick up the data shared with them from the credit card issuers at the end of the billing cycle date. So if my billing cycle ends on the 20th, the credit bureaus are going to pick up that data, and that whatever that balance is on the 20th at the end of my billing cycle, that's what's going to be reported on the credit report. So one of the tips that we like to share with clients is that if you're really trying to maximize your utilization, try to have that as low as possible. What we encourage you to do is either pay off or pay down the credit card balance before the end of your billing cycle, and that'll help you optimize your credit score. Okay. And then the other thing we want to talk a little bit about is with past challenges. So if you've had, and I'm going to give you a matrix on any past late payments you've had or whatever, but if you've had late payments, usually when they've been late in the last 12 to 24 months are going to be the most impactful to your credit score. So once we get beyond, say, the 2-year mark, you generally see a little bit of organic growth in your credit score. Account closure for your reporting, and what we're looking at there is how that impacts the length of credit. Because what happens is when I close out this is only specific to revolving credit cards. When I close out a revolving account, all that good history from that account gets pulled out of the credit model. And potentially there's two things that can happen. One is I impact my score because my length of credit drops because that maybe was my longest standing trade line. Secondarily, your credit utilization could go up because it's all aggregate with your credit limits. And if you close out a card that had, say, a $10,000 limit, that pulls that $10,000 limit out of the utilization equation and could potentially drop your score. So you just want to be careful before you start closing out credit cards because maybe you're moving your business to another issuer because of the benefits or whatnot. When it comes to applying for a mortgage, as lenders, we're always going to look at the middle score between all three credit reports. So if I have a 700 score with TransUnion, 720 with Equifax, and a 680 with Experian, I think in my Experian. So 700 is going to be my middle score. So I take the middle score between all three bureaus. Now, if I'm applying with a co-borrower, or my partner is going to be a part of this application and they're at 760, 780, and 800, we still go off the lowest credit score between the two borrowers. So in this case, my 700 score would be what's used for qualifying. Okay. And then final, before we leave this slide, so you can see the minimum credit scores by product. And we're going to talk more specifically about products in just a minute, but we want to make sure that you see kind of the minimum baselines for those. This is a matrix that kind of shows you, how long those past challenges will be on your credit report. So hard inquiries, 2 years or less. Late payments, they'll be on your credit report for 7 years or less, but the impact is usually in the most recent 12 to 24 months. Federal records like bankruptcies, federal student delinquent debt or tax liens, those can be on your credit report indefinitely. Let's talk really quickly about student loans, because most of our clients, especially our first-time buyers, are going to be impacted by student loans in some way, shape, or form. Now, for those of you that have federal student debt, it's in forbearance, I believe, until June 1st when you restart your payments. From a qualifying perspective, and when we look at kind of the two core products that most first-time buyers utilize, whether it's a conventional loan or an FHA loan, even though you're not making payments on those loans right now because you're in forbearance, we can either take your income-based repayment amount that you had before you entered forbearance with the pandemic, or if you're not in an IBR payment, we'll take on a conventional loan 1% of your outstanding student balance. So if I have $75,000 worth of debt and my IBR payment's $250, that's what I'm going to use for qualifying. But if we're not in an income-based repayment amount, then we'll default to 1%, which would be $750. So that's something we just want to keep in mind when we're looking to qualify. Now, FHA loans have a little bit of a different approach. If I do an FHA loan, that same $75,000, if I'm on an income-based repayment amount, I can use that $250. If I'm not, then we'll take 0.5% of the outstanding debt, or $375 per month. Again, so if you're on an income-based repayment amount, we are in forbearance, but if you entered into that IBR payment before the pandemic, that's the amount that we used for qualifying. Now, questions that come up often from clients is, those clients that maybe have gone back to school, so maybe they're working on their master's program and they're in deferment. Even though you're back in school, we still have to count a minimum amount payment for you on your student loans. Student loans that are in default, you want to try to make good on those, especially if it's federal student debt, because if it's federal student loans, they can attach liens and they can actually report you to a federal delinquent debt reporting called CAVERS. So really important to make sure we get that resolved. But all in all, takeaway from student loans is we're going to either use the income-based repayment amount for qualifying, or we're going to take 1% for conventional loans, 0.5% for FHA loans. Let's kind of look a little more closely at some of the core products that are available to you as future home buyers. So there's the conventional loans and FHA loans, which you learned a little bit more about student loans just a minute ago. There's VA loans for our veterans that have served. That's a zero down payment option. And then there's the USDA loan. And those are going to be for more of our rural areas. We're getting a little bit more interest in these programs because, again, from work remote situations where I don't have to commute down to downtown LA, maybe I want to move out to maybe further out in the desert or whatnot. USDA could be something I could qualify for. And then jumbo loans are going to be for our clients that are looking to kind of finance more than the maximum conventional limit of $970, $800, and maybe put down 10 to 15% instead of some of the minimums. Quick footnote with jumbo loans, not common for most of our first-time buyers to take advantage of the jumbo loans. However, they do have a slightly higher down payment requirement and generally a higher credit score requirement, closer to the 680 to 700 level. The minimum down payment is 10 to 15% just in down payment. But as we kind of talked briefly earlier, there's closing costs when you purchase a home, usually the equivalent of 2 to 3% of your sales price that we'll need to set aside. In addition to that, jumbo loans usually have a reserve requirement. And the reserves mean assets that I have left behind after I've contributed my down payment and closing costs. And it's usually the equivalent of 12 months worth of my monthly payment. So let's just say, to make the math easy, let's say I have a $5,000 mortgage payment. 12 months worth of assets would be $60,000. So I would have to have $60,000 tied up in maybe a brokerage account or possibly my 401k that could help with that reserve requirement to meet the jumbo loan standards. Okay, again, not common that we're going to do a jumbo loan for our first purchase, but those are some of the requirements. Let's take a closer look at conventional loans and FHA loans, because most of our clients are going to be utilizing those products. Conventional loan has a minimum down payment of 3% up to the conforming limit of $647,200. Once you go beyond $647,200, all the way up to $970,800, now the minimum down payment jumps from 3% to 5%. Conventional loans, as you heard earlier, have a minimum credit score of 620. And conventional loans are really going to look at if we've had any past challenges in the last 12 to 24 months, late payments, excessive inquiries, that kind of stuff. It may be a little more challenging for us to be qualified under conventional, and we might have to switch gears and look at FHA if necessary. Now, FHA has a minimum credit score of 600. Sometimes we can go down to 580, but the down payment is 3.5% of the sales price, whether I'm at that conforming limit or I decide to go all the way up to $970,800. The numbers that we're sharing with you for the conforming limit, or sorry, for the maximum loan limits is based upon LA County. So if you happen to be joining us from maybe Sacramento or maybe in Santa Barbara, whatever the case, in a different county, those county limits, those loan limits are adjusted by county. So if you're going to buy in San Bernardino or Riverside County, the maximum loan is $647,200 in those markets. One of the kind of key differences between conventional loans and FHA loans is going to be around PMI, or also known as private mortgage insurance. So we'd like to kind of share with our audience a little bit more about PMI and how that can impact you as future home buyers. Conventional loans over here to the left have different payment options, how you can pay mortgage insurance. It can be monthly, it can be split MI, which split MI means paying some of it monthly, paying some of it upfront. There can be a single premium where you pay all of it up front. And there's also the option of lender paid mortgage insurance. And what that means is your lender gives you the option of taking a slightly higher interest rate in order to buy out your mortgage insurance. Now, PMI on a conventional loan has different factors. They're going to influence the cost of your mortgage insurance. It's going to be based upon credit score, how much you put down, and then how much you finance. So those factors will lead to a certain premium that you'll pay as a buyer. Now, the more you put down, the higher your credit score, the cheaper your mortgage insurance premium is going to be. As I talk with clients throughout the day, I hear a lot of clients giving feedback on like online calculators where the mortgage insurance is a lot higher than they expected. And an example of that is if you look at or how more reasonable mortgage insurance can be versus what you see online. If I bought, say, at a loan amount of $450, I had a 740 credit score, put 3% down, my PMI is roughly going to be about $183. So some of the online calculators may say $350, but that's what that would look like based upon those characteristics of me as a client. Now, PMI on a conventional loan does have a potential cancellation option. So when you have 20 to 22% equity in your home, you can apply potentially to have your mortgage insurance canceled. Okay, so that's the conventional side. Now let's look a little bit at FHA. So FHA looks at things a bit different because the mortgage insurance no longer has the credit score, down payment, and loan amount factors. It's simply a baseline of 0.85% of your loan amount. Divided by 12, that's the premium that you pay for in mortgage insurance on an FHA loan. But in addition to monthly mortgage insurance, there's upfront mortgage insurance, which is 1.75% of your loan amount. Now that amount, whatever it might be, gets tacked on to the top of your loan. So you finance a little bit more with FHA. I'm going to show you a breakdown in just a second. The last thing I want to kind of highlight with FHA is that it does not have a cancellation option. So if you're going to try to get rid of mortgage insurance, you have to look at refinancing your home into a conventional loan. So when we look at FHA PMI, so we have the PMI of $324 a month. So that's that 0.85% factor. And then we add on the upfront PMI that gets added on to the amount financed. So when we compare these two numbers on conventional versus FHA, obviously there's about what $140 difference. So you might ask, why would I choose FHA over conventional, but so much more expensive? Well, It depends because the guidelines look a little bit different for qualifying for FHA. Not only is it a credit score difference, but it's more leniency in FHA around bankruptcies, past delinquencies, maybe a foreclosure or short sale. So just from a qualifying perspective, us as a buyer may need to look at FHA over conventional. You may see as you're maybe doing interest rate research that the FHA loans tend to look a little bit lower in interest rate than the conventional loan, and they do. But what the interest rates don't show is that mortgage insurance is going to be so much more expensive, as you can see in our examples here, on FHA loans versus conventional loans. So our goal would be to get to a conventional loan, but if we just, from a qualifying perspective, need to look at FHA, that's certainly a solution that's formidable for our clients. But it's just something that we want to kind of keep in mind as we're building out that home buyer's game plan. These are the conforming loan limits for this year. So every December, maybe November of the year, these limits get updated by the agencies, Fannie Mae, Freddie Mac, and FHA. So this is what they look like for all of our counties in Southern California. So LA and Orange, of course, because they're going to have the higher cost of living, have the highest limits. And then we have Riverside, San Bernardino, and Ventura, and then San Diego. So we'll see these updated again later on this year. As soon as we get that information, of course, we'll be sharing that with all of our clients. Let's talk a little bit about documentation when it comes to our employment. We call that qualifying income. And so as a W-2 employee, it's pretty easy. We're going to need the last 2 years of our W-2s, possibly tax returns. Tax returns are going to be a little bit more important for our self-employed clients. We're going to need at least the last 2 years as a self-employed client. But going back to W-2 employees, we'll generally need the last 30 days of pay stubs. Then we're going to verify employment in some way, shape, or form. Usually it's written and a verbal verification. With self-employed individuals, like I said, 2 years tax returns, probably a profit and loss statement and a balance sheet. And then we're going to verify the employment or the business, the state of the business, whether that's through a CPA letter or maybe like online verification. When we look at employment, there's a couple of things that we like to share during our workshops. One thing, that gets kind of, there's a little bit of a misconception out there on, is a lot of clients believe they have to have 2 years on the job to be eligible for financing. So it's not actually 2 years on the job, it's 2 years work history and or a combination of education. So if I just finished up school in the fall and I'm starting my career, say in accounting, I just got my accounting degree, my 4 years of undergrad will count towards that work requirement. So I'd have my 4 years of undergrad plus my employment. That would help me satisfy the 2 year requirement. So that comes up quite often. Clients that are looking to transfer jobs. So if I've worked for 2 years on one job and I'm starting a new job next month, can I use the new employment income that I have? And the answer is yes. If it's a base salary, if it's on a straight commission situation or bonuses and commissions need to be averaged over 2 years. So that wouldn't work with the new role. But if it's going from one base salary job to another base salary job, we can use that for qualifying right away. When you have dual employment, we see this often in the healthcare industry. So if I'm working for one clinic here and another over here, as long as I've simultaneously worked for both jobs for 2 years, then I can use both sources of income. If it's a part-time job that I'm doing, I have to show that I've demonstrated working on that part-time job for at least 2 years. That's where it changes a little bit. Now, if for those of us who are just now entering the workforce or we're transitioning to a different job, if we have an offer letter that indicates our pay schedule, when we're going to start that job, we can potentially use that offer letter to qualify you for your upcoming financing. The trick with that is we just have to make sure we get your first pay stub before your first payment is due on your new mortgage. Okay. Ken, is there anything I'm missing on our employment section that we share with our group? Okay. All right. If we need to kind of backtrack a little bit, we can kind of go through some different scenarios if you have any questions. If we haven't had any questions quite pop up yet this evening, but if you do, we can always circle back to that topic. So let's talk about qualifying income. And as lenders, we're going to review your application, validate income, and we compare that validated income to the obligations that you have. We call that a debt to income ratio, and it's just kind of it's a qualifying ratio that we look to help with getting your pre-approval set up. But it's not it's not the affordability level. It just shows us what your pre-tax income looks like versus your monthly obligations, because let's face it, when you guys are budgeting, you're looking at your net income, not what your pre-tax income is. And so the debt to income ratio allows us as lenders to look at your monthly expenses versus your pre-tax. It cannot be more than 45% of your monthly income. Sometimes it's 43%, especially if we're looking at a jumbo product, but for the most part, it's 45%. Here's what the debt to income ratio looks like. It takes into consideration this principal, interest, taxes, and insurance, which you can see down here referenced, PMI, so the private mortgage insurance, which we learned about just a little bit ago, HOA if applicable, so homeowners association dues. So let's assume that's say $2,500 per month. And then we take into consideration other debts, car financing, credit cards, personal loans, things of that nature. Let's say those expenses added up to $500 a month. So if I have $3,000 in expenses and I'm making about $8,500 a month, then my debt to income ratio would be 35.29%. So the maximum we want to see that number is at 45%. On occasion, it can go a bit beyond that, but really we want to kind of manage that to as low as possible, because at the end of the day, we want to make sure we design financing options for you that create affordability and sustainable home ownership. And so for most of our first-time buyers, that debt to income ratio feels pretty good, around 33 to 36%. Some of our clients may be a little bit higher, but generally speaking, 33 to 36% keeps us in a pretty good affordable range. That's a conversation that we'll have as part of a consultation as we build out your home buying game plan. But that just gives you a sense of what the qualifying numbers look like. So let's move from income to now let's talk a little bit about assets. And these are some of the sources that we can utilize for our down payment. So obviously checking and savings account. Where this gets a little bit tricky is if we have transfers for cash or anything like that, those can't be used in real estate transactions. If you have had large deposits there, or maybe abnormal deposits, we have to paper trail everything. If you just got your tax refund or you're expecting a tax refund, that can easily be traced. But any abnormal large deposits, those are going to have to be all paper trailed. Retirement accounts can potentially be used, 401ks, 403bs, IRAs on occasion. With IRAs specifically, you really want to talk with your tax advisor or financial advisor, because we want to make sure we don't create a tax consequence. If at all possible, we want to try to avoid using retirement accounts, but if that's really where kind of our nest egg is for our home purchase, we may need to kind of look at those as potential options. We're going to talk about assistance programs in just a bit. Leanne's going to come on and talk about that in just a few minutes, but all in all, we kind of want to avoid retirement if possible. Now, if you do have family members that want to help out with your home purchase, whether it's a mother, father, brother, sister, that can be used. That's called gift of funds. Does not require any type of seasoning requirement. Any other assets generally require 60 days. And there's a process for completing a gift. Generally, the donor completes a gift letter, provides proof of assets, and then we just need to see the transfer of the assets. So when we think about home ownership and the goal of achieving it, there's usually kind of two things that kind of get in the way of first-time home ownership. And usually it can be credit, which we can put a credit plan together for first-time buyers. Down payment can be that other obstacle that can be a little bit challenging for first-time home buyers. And we're proud to be a partner with CalHFA, which is the California Housing Finance Agency. And that obstacle of having enough down payment can hopefully be overcome with the use of some of these fantastic assistance programs. So Leanne Walker with CalHFA is going to join us now to kind of talk a little bit about maybe how CalHFA can be a possible resource for you, or a tool to be able to help you achieve home ownership with both down payment and closing cost assistance. So Leanne, I'm going to let you take it away and talk about all the great stuff here.
Thank you, Jason. Good afternoon, everyone. Thank you guys for joining in. So like Jason was mentioning, CalHFA, we have programs to help you with your down payment and your closing costs, because the whole state of California now is expensive. So you may be ready to buy a house, you can make the monthly mortgage payment, but you don't have the money saved up for your down payment because rent is expensive as well. So it makes it hard to really save. So that's where our program comes in and helps you with the down payment and or closing costs. So our My Home program will let you borrow up to 3 to 3.5% of the sales price or appraised value, whichever's less. So like Jason was mentioning earlier, if you did a conventional loan, it requires 3% down. If you do a FHA loan, it requires 3.5% down. Our My Home program will cover that full down payment for you. So you wouldn't have to come in with any of your own funds for down payment. The My Home, this is a loan. So it's not a grant, it's an actual loan that you do eventually pay back, but it's deferred payments. So you're not making any monthly payments on this. You don't have to worry about paying this back until you either sell the property, refinance, or in 30 years, whichever comes first. Our hope with this is that when anyone buys a home is that you build equity. So we're hoping by the time it is, when you're ready to pay this back, that you have built up enough equity in your home to use the equity to pay this back. It does have a 1% simple interest, which is very low. So like on the slide, gives you the example. If you got $15,000 from our My Home program, 1% simple interest, that's $150 a year. So that just means every year your balance will increase by $150. Even though payments are not required, you can always make payments anytime if you wish, and you can pay it off at any time. Then in addition, there's our ZIP program for closing costs. So what we see with a lot with first-time home buyers, they just think they have to come in with their down payment, and they don't realize that in addition to your down payment, there's closing costs associated with your loan. So like Jason was mentioning, that it can be anywhere from 2 to 3%. So it just depends, it can vary. Our ZIP program will cover up to 2 to 3% of your closing costs. So in most cases, it covers the majority of your closing costs, if not all of it, but sometimes there may be a little bit left over. But our ZIP program will help cover those closing costs. Like Jason was mentioning earlier about, it is kind of a seller's market. Sometimes you can get the seller to help you with closing costs, but kind of in this market, it's a little bit harder to get. So if you did need help with closing cost assistance, you can use our ZIP program. And like I mentioned, that will give you 2 or 3% to help cover your closing costs. This is a loan as well, but it's zero interest. That's what ZIP stands for, zero interest program. So there's no interest at all, but it works the same as the My Home, where it is a loan. You do have to repay this whenever you sell the property, refinance, or in 30 years, whichever comes first, but there's no interest. So if you got $10,000 from our ZIP program, all you owe back is $10,000, no matter when you pay this back. So here are a couple scenarios to show you how this works. So if you were buying a $500,000 home, so your sales price is $500,000. If you're doing a conventional loan, it requires 3% down. So your minimum down payment would be $15,000. Our My Home program would cover that full $15,000 for you. And then closing costs would be anywhere between $10,000 to $15,000. Our ZIP program would cover the majority of that for you. So if you didn't use our program, you're looking at $25,000 to $30,000 that you would need to come in with your own funds. But using our program, we're going to cover the majority of that for you. And kind of the same with with like FHA. It's going to require 3.5% down. So same sales price of $500,000, your down payment would now be $17,500. So our My Home would cover that full amount for you as well. And then the same with the closing costs. So you're coming in with very little money. I do a scenario similar to this, and just say an FHA loan, and you were doing both our My Home and our ZIP program. You would only have to come in with $272. So our My Home covers all your down payment. Our ZIP covers almost all but $272 of your closing costs. So that's all you would have to come in with to buy a $500,000 home. So not a lot. So under $300 versus $30,000. So that's how our programs help someone be able to get into a home, because not too many people just have $30,000 just saved up. So
Right.
And how long would it take you to save up $30,000 too? And like Jason was mentioning, the rates are going up right now. So this is the time you want to get in before the rates get too high, and then it's going to drop your eligibility down. So the requirements that we have, for our programs. If you're doing the FHA loan, it's $640. Unless you were buying a manufactured house, or if, and Jason will talk more about, this with you personally when he does, do your loan. If you have to do a manual underwrite on an FHA, then it would be $660. But a conventional would be $680, $660 if you had a low income. And then our max debt to income ratio is 45%. So we just don't want you to be overextended. So we're trying to help you get into a home and keep you in a home. So we want to make sure that you are qualified for this loan. The only issue is that you just don't have the money saved up for your down payment and your closing costs. And then we do have income limits. Now the lender does all the qualifying and we use the lender's qualifying income. So we don't do our own calculation anymore. So if you were buying in LA County, you just can't make more than $158,000 to be eligible for our program. So each county is going to have a different income limit, but for LA County is $158,000. If you were buying like in Riverside, San Bernardino, it's like $153,000. So every county is going to be a little bit different, but we only count the income of who's buying the home. So even if you had, husband and wife and only one's going to buy, we only count that one person's income. And so they, on your screen here is just a small chart of some of the Southern Cal counties on here. So just based on the county that, you are purchasing in. And Jason, I was going to mention too about our new program really quick. So
sure, absolutely.
We just announced a new down payment program that is going to be effective April 4th. But it's for low income. So you would have to be within the 80% area medium income. And Jason can help you with that to see if you do meet that low income. But it's a down payment program that will give you 10%. So you can use 10% for down payment or closing costs. So you can use it all for down payment, put 10% down. That's going to lower your loan amount. That's going to lower your payment. It's all the same guidelines as the other programs. You just can't combine this with the other programs. So like our My Home and our ZIP program, you can put those two programs together and use the My Home for your down payment, the ZIP for your closing costs. This program is called our Forgivable Equity Builder. So it's giving you 10% to put down on your home. And the good thing about this is if you stay in your home for 5 years, it's forgiven. So like the My Home and ZIP, you always have to pay that back. This one, you don't have to pay back after 5 years. As long as you live in the house and you don't sell or refinance in 5 years, you don't have to pay it back. So if you do meet the lower income, then that would be a good program for you to get because it's going to give you 10% to help with your down payment. And you can even use some for closing costs. So you would come in with no money at all with that program.
That's awesome. I'm glad you shared that, Leanne. That's good. I was jotting down notes. So
yeah, yeah. So we just announced it. It's brand new. It's going to be effective April 4th. Cool. So that is something that when Jason works with you, he'll take a look at your income and then he can check to see if you are under that income limit. Yeah, and then that might be a better program for you to use. If not, if you're still within our regular income limits, then you can use the My Home and the ZIP. So thank you guys for letting me crash your party and talk a little bit about CalHFA. And Jason is one of our top loan officers, so he knows the program as much as I do. So you are in good hands. So thanks again, Jason.
Thanks so much, Leanne.
Inviting me.
Thanks for joining us. I know it was, you're through travel schedule, wasn't easy to join us. So thanks so much for taking time out on your busy evening. We appreciate you joining us.
No problem.
All right. I'll see you soon. Thanks so much for all the great information.
Okay. Thank you.
Okay. Bye, Leanne.
Bye.
All right, great information about CalHFA and how it can be a resource for you in home ownership. And I'm so glad that Leanne shared with you the low income housing component. That's news to us. That's kind of fresh off the presses. So with a consultation that we do for you as part of building your home buying game plan, we'll take a look at the low income housing component. And what that basically means is 80% of the median income. So I think for most of LA, it's anybody making less than like 68,000 a year. So, but that changes by county. So that's something we can look at if that's applicable for you. Okay, I want to move us along and talk a little bit about the 6 steps of home buying. These are the milestones that you go through in the home buying process. And the first step is our pre-approval. So that's the output of a consultation that we do, whether over video or over phone with you. So we have a game plan put together, and we also provide a pre-approval. What a pre-approval does is it shows a seller that you're eligible for your financing. And the pre-approval usually is good for 60 days. Now, for some of us, we may need a little bit longer, and that pre-approval can be easily recertified at any time, doesn't require you to reapply or anything. But the pre-approval is showing a seller that we as a lender have verified your assets, your credit, your income, and we've selected a program for us moving forward. Now, the pre-approval is step 1. That's the output of a consultation and part of our game plan. Step 2 is going to be house hunting. So that's when we get a chance to go look at different homes. We really encourage you to partner with a realtor, whether it's someone that you find on your own, or you can connect with one of our preferred realtors, whether in LA or Orange County or even Sacramento. We have a network of preferred realtors that we really trust in the experience they create for buyers. Now, while you home shop and maybe you find something for a different price than what we pre-approved you for, we can always update your pre-approval as long as it's within your qualifying range. And that'll usually be updated to match your offer price as part of the negotiating with the seller. Now, home shopping can be a quick process. Sometimes it can be a long process. I've had clients that it's their first week of shopping, they find a house. Sometimes it takes a year, maybe even 2 years to find a house. But at the end of the day, we'll be here to help support you along that journey towards finding the right house. Now, if you find the right house, you make an offer, and let's hope the seller accepts your offer, then you're going to move to step 3. And step 3 starts the beginning of the escrow process, which basically means the escrow is the time at which we have acceptance here to step 6 when we actually get the keys to our house. So what happens at entering escrow? Well, the seller's accepted our offer. You as a buyer will generally need to make what we call an earnest money deposit, which is usually the equivalent of 1 to 2% of our purchase price. And that deposit generally has to be made within 2 to 3 days of our agreement of our contract. Now, we're going to give you a call within 24 hours of the acceptance of offer. In fact, after we're done with our class, I got to call one of our New York clients that just got their acceptance this evening, and we're going to congratulate them on the acceptance, and then we're going to schedule them for a follow-up consultation within 2 to 3 days of the accepted offer. And that follow-up consultation's over video, so you can really understand your closing costs, your interest rate options, your payment scenarios. So we kind of build a new plan now that we're in escrow. We're also going to order the appraisal of your property. Your realtor will help with ordering your inspections. And then after we've got that plan together, then we're going to deliver to you what we call your initial disclosures. Just a little bit more about earnest money deposit. Like I mentioned, it's 1 to 2% of your purchase price. Those funds go towards your total out-of-pocket expense. Now, what's really important to know, that money gets protected while you're in escrow, because as a buyer in California, you have the right to do your due diligence or to kind of do your homework on the property, which would include getting the house appraised. And us being the lender, we'll order the appraisal of the property. You get the house inspected, which your realtor will orchestrate that. And then finally, we'll get your loan approved. The contingency period usually is in the first 14 to 17 days of your contract period. So you're doing your homework, making sure the property is really something that's adequate for you, and you feel good about the condition of the property. Now, as we're moving through the escrow process, we're going to now make the stop off at step 4, which is processing and underwriting. That's where our team's going to be verifying your employment, your assets that you're using for the home purchase. Maybe we're getting your home buying education set up for your first-time buyer program. And then we're going to be requesting any type of additional documentation to make sure everything is situated so we can submit your loan to underwriting. Now, before we get to step 4, especially in this really ever-changing interest rate market, we'll probably have your interest rate locked. And so that'll be all taken care of. The interest rate lock will be set up so your interest rate doesn't change from the onset of your loan to the closing of your loan. Now, the loan is a 30-year fixed mortgage, so ongoing your lot rate is locked. But while you're in the escrow process, there's an interest rate lock period just to ensure the interest rate is protected while you go through the escrow time period. Step 5 is going to be our loan approval. So now that we've submitted to the underwriting department, they'll approve your loan. They issue a final approval. It also brings us to the end of your contingency. So if you feel comfortable with the work that you've seen on the property with the inspections, the appraisal checks out, meaning the appraisal comes back at the value that we need, which we want the value to match the contract price. So if I'm buying for $750,000, we want to make sure the house matches up with the appraised value of $750,000. Now, why that's important is because as lenders, we only can lend on the appraised value or purchase price, whichever is less. So it's really important that those two sync up. Now at step 5, if you're comfortable in moving forward, you're going to sign off on your contingencies. And that tells the seller that you're okay in moving forward to the final stages of the process. Now, what we want to be careful with this is we don't want to sign off on the contingency unless we're comfortable in moving forward, because once we do the sign off, and let's say we get second thoughts 2 days later, we could risk losing our deposit. So it's really important for us to make sure that we're still comfortable with this property. The final thing that we're going to do at step 5 is issue to you a final closing disclosure. And that's your final disclosure that gives you a 3-day cooling off period before we move to the very final milestone. That's called step 6, or closing your loan. That's when you're going to be signing final documents in person with a public notary. Now, everything up until that point, so all the disclosures you've received are all e-signature disclosures. The final closing documents are all done in person with a public notary. That process of signing takes about an hour, maybe an hour and a half or so. Once you've completed that, any other funds that you need for your home purchase, those will be wired into the escrow team. That escrow team will reconcile all the numbers to ensure that you've contributed what you're supposed to as a buyer. That'll also include us wiring in the funds for your mortgage. And also if you've elected any assistance programs, that'll also be wired in. Once those funds get balanced by the escrow team, then they'll release documents to the county recorder's office. And those documents are usually a grant deed that transfers ownership to you and also includes a deed of trust, which is your agreement to repay the loan. And once they get recording confirmation of those documents in the county, you become the official owner. And then we get to celebrate, high five. You get to take a little picture in front of your house with a sold sign, whatever you need to celebrate, because now you've made through the journey of home ownership. It's a big deal. I mean, it's like I said earlier, it's probably the largest investment you're going to make in your lifetime. So us as your lending partner through that journey, we definitely want to celebrate that huge accomplishment. Now, let's back up a little bit, because before we start that journey towards homeownership, it's going to start with a consultation. And that's a 30 to 45-minute session where we build a home buying game plan for you. We go through a lot of the same topics you learned tonight in tonight's discussion. And it's going to include, you completing an online application. We are only going to do a soft credit pull. I think I saw a question come in about the credit report that we pull. We will eventually do a hard inquiry on your credit, but at least for your consultation, it's only a soft credit pull, just so we can see your Equifax score and the obligations that you have. You'll be required to upload some documents like recent W-2s and pay stubs. But once we gather all that information, we'll get together over video or over phone, whatever your preferred method is, and we'll develop that game plan for you. Now, kind of going forward from tonight's discussion, if you maybe have a few questions about maybe your credit or just some income situation that you want to run by us, we'd love to be able to connect with you for an intro call. That's 10 to 15 minutes. You can sign up for an intro call or even a consultation using our link here in the bottom right. So, and you can find all of our information on our website. This is the framework of a consultation. You've heard me talk about it a few times tonight. So it's about budgeting. It's about building that plan, talking about your affordability. We'll review your application, make sure everything's all accurate. Talk about interest rates, closing costs. I'll walk you through the 6 steps of home buying again and make sure you have really good confidence with what the progression of pre-approval to closing your loan looks like. And like I said earlier, the output of a consultation will be to have you pre-approved. Okay, so that's what that consultation will look like. And hopefully we get a chance to connect with you for one of those. We find it really helpful for our clients. It's a free service we provide. We really want to lead with education and get you completely informed and have all the tools and resources you need to make that journey towards homeownership. Now, we have some fantastic tools, which include our mobile app. You can even start the application process right there. It's good for Android and Apple. You can also use the calculators, which we see a lot of clients using those. You can upload documents that you need for your application. Now, if you found out about our classes through our different partnerships, like I mentioned earlier, we have a discount program for some of our different alumni that we support, as well as for state employees in California. And what that does is it discounts our services by $750. So normally we have a $910 processing fee. That fee gets dropped down to $160. We want to make it more affordable for you with homeownership. And part of our different partnerships, we love connecting with clients for consultations, not only teaching these classes, but connecting with you for consultations and providing that plan of homeownership. Now, if you've enjoyed some of this information that we've shared this evening, you think maybe a friend, family, maybe even coworker might enjoy some of these topics, we have some other workshops that are coming. In fact, we're going to teach a class for USC tomorrow night and some of their alumni, as well as some other classes for different markets in California. So we're not just teaching just for LA, but we're other classes that we have available. So you can always go to mortgageeducate.com to learn a little bit more about those other classes. If you want to connect with us after tonight's class, I'd love to be able to meet up with you for either an email or a call, or you can schedule your appointment using some of this information here. But here's all my contact information. And I would also encourage you to check out us on some of our social channels. We love to celebrate homeownership and the accomplishments that all of our, kind of graduates from our workshops make with achieving homeownership. So check out some of the testimonials that we have on Instagram. We have on Yelp, on some of our Google reviews. We're really proud of what our clients are accomplishing and then what they're saying about us and their experience of working with our team. So with that said, I'm going to go ahead and hang out for a little bit longer. We've come to the end of tonight's presentation. So I know we haven't had a lot of questions this evening, but we're going to hang on the line here for a few extra minutes. So if we do have some questions, and then I'll cue everything back up and we'll wrap up for tonight's conversation. All right. I'll go ahead and shut down the video and just mute out, and then we'll bring some questions if we have any. Thanks. Okay, we had a question come in, and I'll share this back with the group. So just a really question about past challenges, like let's say you have a charge off on an account. Is it something that would kind of make it ineligible for financing? So that's not necessarily the case. So some clients have charge offs. We'll just want to see how the charge off has affected the credit. Charge offs are different than collections, and I'm glad this question came up, because charge offs you can potentially settle. And if that settlement posts to your credit report, which we can ensure it does, that'll usually give you a pretty good boost in your credit report. Now, it does stay on your credit report for 7 years, but if you're trying to get the debt eliminated sooner than that, that would make possible sense to settle. That would lead me to another kind of tip that I would share with everybody, and that's around collections, because charge-offs and collections are different. Collections, if you have one, whether it's a medical or whatever the case may be, those will stay on your credit report for 7 years, as we know. However, when you try to pay off a collection account, even if you pay it to zero, it's not going to give you a lift in your credit score unless you get the creditor to delete the file from your credit. So if I'm dealing with a collection, you want to get it paid off, and request that they delete it. That sometimes works, sometimes it doesn't, but I would always encourage clients trying to get that, kind of resolved to try to ask for a deletion. And that's a good question there. Okay. I think we're probably about that. And we didn't have a lot of questions tonight, but if something comes up and you guys just want to shoot us an email or just message us in general, more than happy to follow back up with you with a response. And then, like I said, if you want to schedule an intro call to kind of go through a particular situation, that works great too, or we'd love to be able to connect with you for a consultation. Any of those ways we can help support you on this journey towards homeownership. So with that said, again, I appreciate everyone kind of being flexible on the change in dates. If you missed some of the earlier content, we're going to have plenty of classes that you can join. And we look forward to hopefully connecting with you soon. Have a wonderful evening. We'll see you soon.